or something. I remember it just being awful. So hopefully in for a good day on Sunday, and happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by going through all the latest, greatest, and wackiest in the never changing and always unpredictable mortgage industry. And Rob, we've been talking on the show just about the really uneven start to the year. And, I think things just go off the rails would be too strong a term, but, inflation number again this week, higher than expectations, 7.5% year over year, annual inflation. 10-year treasury, we talked about this last week, went over to hit 2.05 today. First time that's eclipsed 2% on the 10-year yield since 2019. The Senate Banking Committee, the Democrats and Republicans are fighting about housing, and Democrats and Elizabeth Warren blaming the Wall Street investment firms for gobbling up all the homes. Pat Toomey and the Republicans blaming Fannie and Freddie and Fed MBS drunken buying. And, and then you just can't go to any major media outlet right now in America without seeing something about the housing market near the top of the page. Make sense of it all for us.
Well, first, there's a question in the chat room about Cat Bowl. In Reno, they're about to open a cat bookstore where I don't know where these cats come from. I don't know any self-respecting cat that would want to hang out with total strangers, but they're opening up. You can go read books, buy books, sell books, and there are cats milling about. So I don't think Myrtle will go anywhere near that. Yeah, how do we make sense of all this is a great question. We've been talking about rates going up. This is no surprise. We're in a cyclical business. We've been talking about rates. We talk about rates almost every show, where rates are going to do what they're going to do. And the question is, how are lenders going to react? So we've been talking for a while. Rates were low for a lot of 2020, 2021. We knew that they didn't have a lot of room to go down, even though some people were predicting they would go down. So now they've gone up, as most people thought they would. They are expected to go up farther, which shouldn't be a surprise to anybody if and when they do, because the economy is churning along. Inflation is a problem. The Fed is viewed as being behind the game a little bit in terms of adjusting to these inflation numbers. And one of the mandates of the Fed, it's important to remember, is the stability of the economy. And it's viewed with a 7+% annual inflation rate at the consumer level, that is not really a stable economy. And so the Fed is having to play catch up here a little bit. I'm frankly surprised they're still buying Treasury and mortgage-backed securities every day through the New York Fed desk, but they are. And so we're in a situation where now the experts out there are talking about Fed funds. Is the Federal Reserve going to ratchet up Fed funds 5 times, 7 times, quarter point, half point? A month or two ago, somebody asked me if I thought that if the Fed would do half point increases, and I said, probably not. That's pretty drastic. But now drastic times call for drastic measures. And so we may get a Fed funds rate ratcheting up of 0.5%, in which case, what does that do to the yield curve? It certainly flattens out the yield curve, but long-term rates are going to go up, and long-term rates include 30-year mortgages. So now we're dealing with an environment where, okay, rates are going to go up. It's like me telling you, Rich, IBM is going to go up in price. The stock price is going to go up. What are you going to do? Well, you're going to buy IBM stock. If I said bond prices are going to go down and rates are going to go up, a logical person, a sane person would say, well, I better better sell whatever bonds I have in my portfolio, because the value is going to go down, and I'll take that money and put it somewhere else, maybe into Treasury inflation adjusted or protected securities, whatever it might be. But rates are by all intents and purposes going to go up. So the question is, what are the lenders doing out there? What are the vendors doing out there in order to adapt to this new environment? Now, there's a lot of hand wringing right now, and I have a good letter in tomorrow's commentary about keeping things in perspective, and not so much perspective where you talk to some old grizzled veteran who was around way back in the Carter administration days, and the prime rate was 18% or whatever it might be, but just somebody who's been in the business for 5 or 10 years. And yeah, rates are going to go up, rates are going to come down again, rates fluctuate. And so the more important question is, how do you adapt to it? As a lender, what kind of products do you offer your borrowers, or your borrowers who are coming back to you saying, hey, we bought this house 5 years ago for 300,000 and now it's worth 400,000 or 500,000. We've got a lot of equity. We've been making our payment on time, but Moon Baby wants a Sprinter because we want to check out the fall colors coming up, and so we need some money. Or little Sage is heading off to college, and we don't want to get a student loan, so we need to pull some equity up. So lenders are looking at these things, say, okay, what products do we have to offer these individuals? And originators are changing the dialogues that they have with borrowers in terms of what's going on with your situation. You want to buy a house, okay, fine. Or you want to refinance a house because of some reason, okay, let's figure this out. Let's figure out. And oh, by the way, we can do away with the mortgage insurance premium, so we can save you some money there. And let's do this to your credit profile, and that'll save you some money because we'll get you a lower rate. So the conversation that originators are having with borrowers or potential borrowers has changed in the matter of months. And the good originators, the good individuals who are out there originating loans right now are tearing their hair out, because rates are going to do what they're going to do. The question is, how do you adapt to it? So rates are going to go up. Profit margins have come down. You have, especially on the wholesale level, wholesalers whose profit margins have been cut to the bone for quite some time. It's almost a matter of who could hold their breath the longest in this kind of environment. And as the months in 2022 passes by, I think we're going to be in a changed environment where owners are going to stop holding their breaths and say, uncle. And I had breakfast the other day with Garth Graham from the Stratmore Group, and we were talking about mergers and acquisitions because that's his specialty, even though he's very good at other areas of the business. And he said right now there's more buyers than sellers of lenders, but he's seeing a shift toward more sellers than buyers. And the reason for that, I don't mean to blather on here too long, Rich, so I'm sorry, I'm hogging the soapbox, but he's saying that 2020, 2021, very good years, very good quarters, some very good returns that these lenders are having. Well, December didn't look so good, and January was a loss, and February is not looking much better, and March and April and May. And so owners who may have been thinking about selling their businesses, and the return that they wanted, or the sales price that they wanted, which oftentimes is based on the P&L for a particular lender for a certain amount of time, if that income turns negative, that's a problem in valuing that company. And so he's seeing definitely a pickup in interest in sellers of especially small and mid-sized lenders who are out there saying, I don't want to go through this rodeo again. We've had a great year. I want to value my company based on the great 2020 and 2021, not the first and second quarters of 2022, because things aren't looking so good. So he's seeing a pickup in the seller interest out there, especially among owners who are older and just don't want to go through this again. So you're right, there is a lot going on, but through it all, I think that I've said this before. We're here to help borrowers, and we'll continue to help borrowers regardless of the interest rate climate. The question is, how do you as an originator or lender handle the higher interest rate climate?
Yeah, a lot of good stuff there. And yeah, I think what Garth is saying echoes what I'm seeing and hearing as well, is more interest from maybe those that were on the fence to sell, because I think what we're seeing is the results of right or wrong government action, and in some cases inaction, that makes it feel like it's going to be really a couple very tougher than even anybody thought a few months ago years for the mortgage industry. The whole inflation is transitory thing, and now we're seeing inflation's a serious problem, and now we're seeing more than a 50% chance of a 50 basis point hike at the next Fed meeting is now priced into the Fed funds future market. So the market is now more anticipating 50 basis points instead of 25. One of the Fed board directors, James Bullard, came out publicly yesterday, called for 100 basis point increase at the next Fed meeting. That was really what caused the yield on the 10-year to eclipse 2%. So it feels like interest rates are here to stay in terms of this new kind of 4% level. And then, on the government inaction side, if you read the coverage of the Senate Banking and Housing Committee meeting that was yesterday, a lot of telling things in there. The Democrats, led by Elizabeth Warren, screaming about institutional investors, as we have been. It's had a huge impact on the market. 25%, I think, is the CoreLogic data of home purchases last year by institutional investors. So clearly gassing the fire here in terms of affordability and lack of affordable home ownership. And then the Republicans talking about Fannie and Freddie policy and the Federal Reserve bond buying policy, but also talking about the home builders, something else we've been talking about for a year. How about you make it a little bit easier for the people that actually create new housing stock in America to actually do that? So to me, that felt like some foreshadowing with a midterm election coming up, housing and real estate prices and affordable home ownership in the headlines of everything starting to become a political football. I think we're starting to see maybe the foreshadowing of what we're going to see, but the politicians angling for and trying to get through as we get into this year.
Yeah. I'll get to that in a second. I should mention that there is a question in the Q&A box about why is Fannie Mae is pulling DU ability from some lenders and advising them to run DO. Why is this occurring? So why is Fannie Mae pulling DU ability from some lenders and advising them to run DO? I don't know the answer to that. If somebody wants to throw a chat into the chat box, that might be helpful. So Rich, yeah, the politics, the interesting thing about politics is that you have a fair amount of posturing. Well, there's a lot of interesting things about politics, but there's a lot of posturing that goes on. The system itself isn't broken. Anybody basically who wants to get a loan, who's decent, has credit worthiness, can go out and get a loan. That's always been the case, and we've been helping millions of borrowers around the nation do exactly that. You can have the Elizabeth Warrens out there, the Bernie Sanders, or whoever it is, talking about this, that, and the other thing. Just today, I talked about affordable housing in my opening paragraph, and recently I mentioned there's a community south of San Francisco, Woodside, that they were going to put in affordable housing, and then they said, well, wait a minute, this is mountain lion habitat, so we're not going to put in 80 or 100 units of affordable housing. And then Dave Chappelle, his hometown in Ohio, was considering affordable housing, and he said, well, if you do that, I'm going to pull plans for my restaurant and comedy club. And so the town council voted it down. So you can have these directives coming at us as an industry from Elizabeth Warren or Joe Biden or whoever, but by the time you get down, filters down to the community level, things get really messy in a hurry. And I know we had Ivy Zellman on some months ago talking about an imbalance. And I don't agree with her, but she has a much larger research staff than I do. but I just don't see the imbalance out there. I continue to drive through neighborhoods and there's no inventory. And granted, some of that inventory has been sopped up by institutional buyers, large companies that own residential real estate, and they stepped in great degree in 2008, 2010, 2012, stopped this big foreclosure wave that we were fearing was going to happen. And so they stepped in and bought units, and they've owned them ever since, and they rent them out. And I'm not a fan of it, but let's not forget the role that they played 10, 12, 14 years ago. So let's not forget that they did serve a purpose. But if rates go up, affordability becomes an issue. If rates go up and prices continue to appreciate, if companies decide to sell, they're start to dribble out their holdings of single family homes, I think there's a ready market for those homes among the 70 some odd million millennials that want to own a home. Well, many of them already do, but there's still a lot of recent immigrants and a lot of people in their 20s and 30s who don't own homes yet, who would love to buy a house from even if it's from a corporation, and own that for themselves. But remember, Rich, the corporations are pretty impersonal, and they're based on the bottom line. And if they're making a lot of money on rent, they're not going to be so inclined to sell. And I don't know what Elizabeth Warren is going to be able to do to twist their arms and make them sell. So a lot of things going on out there. And sure, the housing market, real estate market, lenders are easy targets sometimes for politicians and for regulators. But I think we've done a good job here in recent years, keeping a lot of that at bay and continuing to lend money to borrowers. So I don't know. What do you think?
Well, first, if you haven't seen the Chappelle YouTube, I think it was off the link in your newsletter this morning. It is entertaining. It's worth watching. He lives about an hour and a half from me, and it's a cow town, literally, that he lives in, and has pumped a ton of money into it. And but he's understandably become quite a celebrity there, and the people in the council meeting are like cheering him on as he's giving his little soliloquy on how he's going to pull all his investments and all his money out of Yellow Springs where he lives. But it speaks to the larger point that you've been talking about for many months now, that you talk all you want about affordable housing policies, and it's tough to enact because a lot of it has to be passed at the local level. And I think the Chappelle video, regardless of what side of it you're on, it speaks to that, right? And that's I think a microcosm of some of the tough parts about getting the issue. What we've talked about is the issues that plague the housing industry right now in America. There's no easy fixes. I think what you're going to see, being an election year and being the fact that the companies that are buying, the institutional investors that are buying these homes, it's okay to offend them publicly, politically, because they don't have a lot of people that are sympathetic to them. So I think you're going to see the Democrats try to enact some sort of legislation that makes it tougher on a go-forward basis for institutional investors to buy homes with certain, I'm sure, guidelines and guardrails. And I think on the other side of the ball, you've got the Republicans and Pat Toomey, and he said, listen, it's free market. The institutional investors got the capital. When you have this type of housing market, they're the ones that are coming to buy the homes, and you can't stop that, is what he's saying. And that's the market's in movement. And what he's saying is, I would be focusing more on the drunken buying spree from the Fed on these mortgage-backed securities. I'd be focusing more on the fact that home builders can't build a house in America under $450,000 without losing money. He talked about appraisal waivers, feeling like that was a dangerous precedent that Fannie and Freddie were setting. I think maybe it was not him, but somebody on the Republican side calling it a race to the bottom. So I think you're going to see the politicians on both sides trying to begin to enact legislation that they feel can help the problem. And it's going to be conflicting. And I think that it's going to keep housing right at the top of the news feeds throughout the spring at the least. So,
yeah, perhaps the out west, and I happen to be in Miami today, but out west, there's maybe they're nationwide. I don't know. There's a company called Picasa, and Picasa's business model is uh, to buy a very nice home in a very nice neighborhood and then fractionally sell off, weeks or months of that. And local communities, neighborhood HOAs and so forth, are coming out against that plan, because they'll say, well, we don't want a company owning real estate, or we don't want some kind of partnership owning it, or whatever it might be. And then you have other residents in the area saying, well, wait a minute, my wife and I own our house in an LLC. We have a little, an LLC that owns our thing, our a trust owns our house in case we die, and so forth and so on. So yeah, there's a lot going on, but my point is that the federal government can do all kinds of things, but there's a lot of smart companies and a lot of smart individuals who are good at getting around things that the federal government proposes. And so the federal government might, there's a saying about the army is busy figuring out how to win the last war, and they're not too forward thinking. I would say the same thing about some politicians. They are trying to solve problems that may have existed 5, 10, 15, 20 years ago, but going forward, it might be a different environment. So who knows? But in the meantime, the lenders out there, they are tightening their belts. They're girding their loins, whatever a loin is exactly, in preparation for this year. And I think that regardless of what might happen in Washington, D.C., and what Elizabeth Warren is to me, or whatever's going on at that level, a lot of companies out there, basically every lender wants to go out and continue to make money and continue to try to go after market share, and originators want to do the same thing. They're trying to help their clients. And so some of this stuff might just be noise, but yeah, it's a good idea to keep an eye on it.
Yeah, and valid points about just getting things done with government. And, I wasn't into any of this stuff is going to be enacted soon or effective, but I think you're going to start to hear more talk about it, just because, again, it's a political football right now, and something that is kind of hit Main Street in America, and not a lot of time since '08 that housing has really been in the forefront of issues that voters are concerned about. But housing certainly starting to get there. And, again, even if they do go down the path of passing legislation, either side, you got a 50-50 Senate and election year. It's a tough time to get things done. And even if it does get done, it's nothing that will help anything in the short term. And if inflation continues to be as much of an issue and as it has been, and you get 7 Fed moves priced into the market, as opposed to, right now you got probably 5 priced into the market, it's going to continue to push mortgage rates up. That's just simple market forces at work. And there's nothing at all that is going to help the supply side at all. So you could be in a situation this year where you've got 30-year fixed rates in the mid 4s with the continuing dwindling of already historically low levels of inventory. And pretty much anybody that wants to buy a home, unless you are really well off or willing to make a big bet on overpaying or, backing up the Brinks truck, it's going to be it could be very, very tough to buy a home in America. I bought Lowe's stock today because it's going to be, I think this is like I can't move. Let's just continue to improve the home year. And I don't know. These are things we've been talking about 7-8 months, predicting exactly what has now happened. And there's nothing that can change it outside of something happening geopolitically, or bad with the pandemic, or something that would force rates back down, that would reverse Fed movement. That would have some impact on the affordability side of it, not the supply side of it. But demand is still there. There's a lot of Americans that want to buy homes. There is a huge shadow inventory of people that want to buy a home and cannot right now. I mean, if you looked at Fannie Mae's home purchase sentiment index that they came out with this week, the worst time in the history of that index to buy a house, I think it was 84% of people between 18 and 39 said it was a bad time to buy a house right now. Only 13% said it was a good time. And that was by far the most accelerated you've seen either of those numbers. So,
Well, I think people vote with their pocketbooks. And so I could sit here and say, God, this is it's just a terrible time to get my teeth cleaned, but I'm going to go get my teeth cleaned. I'm not going to not get my teeth cleaned because it's a terrible time to do so. Terrible time to buy a house. I don't know why they're asking an 18-year-old about buying a house to begin with, but nonetheless, you could say, oh, it's a terrible time to buy a house, and they're going to go out and do it. I was talking to a friend a couple of weeks ago, and he was saying, oh my gosh, just I think we're heading for a bubble. The bubble's going to burst. We're heading for a downturn in real estate, you know. And I said, well, are you going to sell your house? Oh, of course not. He goes, if prices go down, I'm going to buy another one. So you have this mentality where, or a situation where you have a lot of people with a lot of savings who don't own a home. And the question is, where do you want to put your money? What is it that you know about your or possible investments that are out there? And you look at stocks and you think, well, am I going to buy a bunch of IBM stock? Well, IBM stock might go down. I don't know enough about valuing equities. Or should I buy bonds? Well, gee, bond rates are going to go up, so I don't want to buy bonds. Do I just hold it in cash? Well, you know what? Holding in cash where you're earning nearly 0% on your bank account versus an inflation rate of 7%, you're going to lose money. Well, where am I going to? Well, I'm going to put it in real estate. People want to own real estate, and the people who don't own homes want to own a home. And I know that's kind of a generic blanket statement because a lot of people shouldn't own homes who may own homes or want to own homes. But nonetheless, to your point, the demand is there and people are comfortable owning real estate. They like driving through their neighborhood and pulling up and they like painting their fence on the weekend. They like the fact that they own a home. They don't get that same intrinsic value with owning 100 shares of IBM stock that might go down. They don't get that with cryptocurrency, Bitcoin and so forth. It makes the headlines, but I think the majority of people don't understand it. And there's sizzle there, but people are asking, where's the stake with cryptocurrency? So I think that real estate will continue to be a good investment. And once again, how are lenders helping borrowers out there finance these homes? And that's the important part.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman. And in the chat, looks like from Loan Originator, a day in the life, 14 well-qualified pre-approvals make offer, 1 accepted. So I think that, is representative. And can't go without talking about 2 of my favorite topics, United Wholesale and Better.com in the news. Once again, and we asked Matt Ishbia to be on the program today, and we never heard back from him. So, but we wanted to have him on to hear about his suing mortgage broker strategy and how that's going for him. But he did not come on. It's
so I'm not going to. Rich, I could sue you for your wardrobe. Mm-hmm. You could sue me for whatever it is. Anybody can sue anybody. The question is, what is the long-term impact of that? And you're right, it's not a good PR play, but United Wholesale, there's some pretty smart people there, including Matt Ishbia, and I think that was a calculated move. And I think, it's like. I think they view it as you are a Ford dealer. You build a Ford dealership, and Ford financed that dealership, and Ford is supplying you with cars, and all of a sudden you open up a little corner to sell Teslas. Well, Ford is going to come in there and say, wait a minute, you're not supposed to be selling Teslas. You're supposed to be selling Ford. In fact, we help you. We supplied all the software, and we supply the cars and the financing and this and that and the other thing. And now you're selling Teslas. Well, that's unacceptable. So United Wholesale is taking the approach that, hey, we supplied you with a website and underwriting and this and that and marketing, et cetera, et cetera. And now you're doing this to us. So yeah, we're going to go after you in court. It wouldn't surprise me if they won. It's not a great PR move, just like AIM, rejecting the attendance of somebody who is veered away from United Wholesale isn't a good PR move, but it's a calculated move. So makes for good conversation though.
It's like the drug dealer business model. You give out a little of your supply and get people hooked, and then you got them in your clutches. So. And then better.com, this company's never going public. I'll tell you that right now. They just mistimed it, the whole Zoom firing thing. And then today, they lost $111 million during the first 9 months of last year. Those were the good months. Corporate spending was just through the roof. And you'd have to be insane to take this company public via SPAC right now, given the leadership, given the climate, given the way other mortgage stocks have performed. This company's never going public.
I'm not going to disagree.
Okay. So what else before we take it into the weekend here? I think we hit on enough of the negative housing sentiment stuff. You mentioned Super Bowl, obviously this weekend. You want to see the Bengals win. Any predictions for the game or the commercials or no?
No, you're actually betting on the game.
I've already bet. I'm on the Rams -4. A little bit of shade on the under 48.5. So I'm 27-13 Rams is my prediction. You look at what the Titans did. The Bengals offensive line is really terrible, and it is a team that has. I mean, think about the Bengals. They barely beat the Raiders. Raiders could have easily won that game. They only beat Tennessee because of 2 horrific Tannehill interceptions that just gave them the ball in Tennessee territory. They barely won that game. And then the Chiefs, I don't know what the hell happened to the Chiefs in the second half last week, completely melted down. Chiefs still should have won the game in overtime. So the Bengals, they have had a lot of fortune to be in this game, and their weakest unit, their offensive line, is the Rams' strongest unit. I would just, again, point back to what Tennessee completely shut down Cincy. I expect the Rams to just really completely own the line of scrimmage and make things difficult for them. So
I can't, Rich, your depth of knowledge, your range of, I just, you know a lot more about that than I do.
Some comments.
I wish the best for you. I hope you can retire off your wager.
I don't think that's going to happen anytime soon, but a couple comments in the chat. One, echoing my Lowe's stock purchase recommendation, because first-time home buyers are buying older homes due to the inability to afford new construction, so they have to fix stuff in their 30-year or older home. Yes, that is another reason, and just home improvement jobs in general. My best friend, he's getting his kitchen redone. He had 2 contractors come out, and both were $70,000, between $70,000 and like $85,000. Do it, but buying the stuff through. This was Home Depot, but and using their contractors, like $35,000. So I feel like they have a real niche there as well. Some Burrow Super Bowl noise in the chat, and but that's about it. Anything else before we take it into the weekend? What are you doing in Miami?
I'm actually staying with Rob Hurt, who owns Lenda/RPM down here.
Yeah, they allegedly want to join TMC, so put in a good word for us. So yeah,
I will do that.
So
all right.
Excellent. Well, as always, greatly appreciate your time on Friday afternoon, spending some time with us to take things into the weekend. And we will be here, as always, next Friday at 3 p.m. Eastern with the rundown with Rob and Rich. And Rob, until then, enjoy the Super Bowl. Have a good weekend, and I'll see you next week at the latest.
Sounds great.
Take care, everyone. Have a nice weekend.